How is investment portfolio rate of return calculated? Imagine you have a collection of investments, and you want to know how well they performed over time. That's where the rate of return comes in. It tells you how much your portfolio has gained or lost as a percentage. To figure this out, you start by looking at the value of your portfolio at the beginning and at the end of a specific period. The simplest way is to subtract the starting value from the ending value, then divide that number by the starting value. Multiply the result by 100, and you get the percentage change. For example, if you started with $10,000 and ended with $12,000, the calculation would be 12,000 minus 10,000, divided by 10,000, then times 100. That equals 20%, meaning your portfolio grew by 20% over that period. But this simple calculation works best when there are no extra cash flows, like additional deposits or withdrawals. If you add money into your account during the period, or take some out, it can skew the results. To handle this, there are more advanced methods. The first is called the time-weighted return. It breaks the total period into smaller parts whenever cash flows happen, calculates the return for each part, and then combines them. This method helps you see how well your investments performed, independent of when you added or removed money. The second is the money-weighted return, also known as the internal rate of return. It considers the timing and amount of all cash flows, giving you a true picture of your personal investment experience. If your portfolio earns dividends, interest, or other income, you should include those in your calculations. In that case, the formula adjusts to add the income received during the period. For example, if your starting value was $10,000 and you earned $500 in dividends, with an ending value of $11,000, the calculation would be $11,000 plus 500 minus 10,000, divided by 10,000, then times 100. That results in a 15% return. For longer periods, investors often want to know the annual growth rate. To do this, they use the compound annual growth rate formula. It takes the ending value, divides it by the starting value, raises that to the power of 1 divided by the number of years, then subtracts 1. This gives a smooth, yearly rate of return that accounts for compounding. Knowing how to calculate your investment portfolio's rate of return helps you see how your investments are doing, compare different portfolios, and make smarter decisions about your future investments. Whether you're tracking your progress or evaluating a manager's performance, understanding these methods makes your investment journey clearer and more manageable.